Hey everyone, welcome back to your channel. Hope everyone had a really good summer. We're entering into fall now and I finally have some time to make another video. But instead of picking a specific financial topic to talk about this week, I thought I'll do something different. What I'm going to do is I'm actually going to go online and find several postings on Reddit, people describing the situation, asking about financial planning questions, and I would go through each question with you guys and answer from a planner's perspective what I might say to them if they were my clients. Some of these are like commonly asked questions. My clients do ask me from time to time as well. So I thought it would be interesting, and it kind of captures a variety of different scenarios that instead of just picking a very specific one. Now, this is the first time I'm trying this format. So if you'd like this in addition to the specific topic videos, let me know in the comment down below. And before we start, help me like this video. That's the best way to support our work. All right, so let's dive into the first question that I found, and it's about commuting your defined benefit pension. So this person posted on Reddit saying that they basically still have over a decade before retirement, but they're thinking through the retirement scenarios. They have a pension, and luckily they started working when they're very early at the age of 20. So by the time they hit 50, they would have their unreduced retirement already. Now, her wife is a teacher, so she has a pension as well, but she will retire after him because she started later. And he's basically saying that conservatively estimating if he were to commute his pension at 49, he would be able to take the cash value at around maybe 1.9 to 2.1 mil. That's the safe estimation for him. If he were to max out a LIRA as well as RSP and TFSA, then he would be taxed on the remainder. He likes the idea of if he were to pass, there's an entire amount left to his family. And his question is basically, would he be in a better position if he were to take this out, invest by himself, and probably can replicate the same income as a pension plan, if not better, and he would probably wait until he's 55 or 60 before it start taking the income. All right, so this is actually quite commonly asked among my clients as well, and there are several things we need to know here. First of all, the two accounts that it can transfer to tax-free is a LIRA, locked-in retirement account, or your RSP if you have RSP room. You actually cannot transfer tax-free to TFSA. It would have to be taxed as income first, and you would be using the net amount to put into a TFSA. Now for LIRA, it actually follows a specific calculation. It takes something called your age factor times your annual benefit from the pension if you were to start. That amount that you get is the maximum transferable allowance that allows you to put from your DB pension towards your LIRA. So for example, if he were to retire at age 50 and let's say his annual benefit is $80,000 a year, we would take the age factor at 50 times 80K and it would come out to be around $750,000. And the rest of it, if he has RSP room, whatever room he has, he could transfer the next portion into the RSP. Whatever is not transferred by then will be taxed as income that year, so it can be quite a bit of tax. Now, this idea could work. In fact, it is very suitable with clients in specific situation. There are a few things you want to look at. The first one is probably your risk tolerance, and from there you can gauge what is the expected rate of return you can expect to get if you were to invest by yourself. However, because the amount it is over $1 million easily, if a client were to ask me, I would highly recommend we engage in an actuary. In these kind of calculations, it's very difficult when there's more than one moving variables. So for example, your life expectancy can be different, inflation going forward can be different, maybe the government bond rates could be different as well going forward. All these is going to affect the average return you have to get in order to match your pension or do better than your pension. It's not something that we can just plug into an Excel and come out by ourselves. Now, there is another thing to consider in this scenario is that the spouse is a teacher and she also has her pension. So because now you have two DB pension, you can see if her pension is good enough to sustain at least half or if not all of your living expense at retirement, then maybe you don't even need to consult an actuary. You can just say, hey, I'm gonna commute the whole thing because I really don't need that income. So I could invest it very conservatively and I would like to save that whole amount for my next generation or use that large amount to buy something else. This actually is very common with some of my clients who are both federal workers or they both RCMP, and it would make a lot of sense if one of them commute their pension and invest by themselves. All right, so on to the second question that I found that's quite interesting, and this one is about co-signing mortgages, which I also see a lot of clients asking me about. So the scenario here is that it's not the poster, it's actually his fiance and her sister. The two daughters are co-signing with the parents together. The issue right now is that the parents have a house that's worth 1.1 mil. Their total mortgage is 750K, renewing in 2 years. As of right now, they cannot qualify for mortgage by themselves, the parents, because the dad is a self-employed and I guess the income is just not there. You do need 2 years average for self-employed to qualify for a mortgage. So they're asking the daughters for help, and the idea is that in 2 years, the dad is going to have enough income on paper to support a renewal by themselves. They would take the daughters off of the mortgage. Now, some additional info here that I thought was kind of weird is they mentioned some things that the consolidated mortgage is 500K, half of which is already drawn, with the other half drawn next year, that will be paid out next year. And this 500K was originally used to build an additional housing on the property, but the plans have changed and now the second home will not be built. He further listed a bunch of possible risk that he sees, and he's basically answering himself on why these aren't an issue and why I guess he doesn't think it's a big problem doing this, and he's just asking for additional opinion whether we see something that they don't. Which I'm gonna say, yeah, there's quite a few things. If I were a planner, you coming to me with this scenario, I would be asking you for clarifications. Now, first of all, if a client ever asks me if they should be a cosigner, guarantor, or just be on title with anyone in the family or friends that's not their spouse, I would usually lean towards a no. I would listen to the story and see if it's really necessary, but I haven't really found a scenario where being any of these things with anyone other than your spouse is a good idea, because you will be opening yourself up to liabilities, and there are two that I can see with this scenario. Now, the first one is missing payment, obviously. If the parents can't make payments anymore, the two daughters would have to resume the mortgage and make those payments or risk going into default. Now, this is addressed by the poster by himself. He's saying that the parents, because the other 250K mortgage was not drawn yet, they could take the money from the mortgage to make those payments, so payment wouldn't be an issue. So this is a red flag, because immediately I'll be asking them, why haven't they gotten any income or cash flow on the side to pay for the mortgage payment? Why are they relying on debt to pay debt payments? Now, another mystery here is they mentioned that this 500K mortgage, which half is already used, was supposed to be for a second home on the property. I'm guessing a laneway house, and it fell through. So I'm questioning why then we need to borrow the rest of the mortgage. Why couldn't we just return the 500K back to the bank and say we're not building the house anymore? What's going on there? Did they use the first half for something else other than building a house? That's why it fell through. Because all these are red flags on how sustainable mom and dad is with their finances. If they use the first 250K for something else other than building a laneway house, who's to say they won't use the next 250K for something else, maybe investing into the dad's business, and then it doesn't work. So now they don't have that 250K to pay mortgage payment for the next 2 years. Then what? Are the daughters now on the hook? Now, another issue is that the plan is for the dad to pay himself salary for the next 2 years, so he has that income on paper to qualify for mortgage themselves in 2 years. My question would be, if he's paying himself salary, where is that money going? Why aren't we using it for a mortgage? Was it because it's not enough? Or is it because there is no salary? He's just making up transactions on paper just to qualify for a mortgage by himself. What's going on here? I would find out about that as well. But just from those questions, there's already a lot of red flag that suggest this problem is probably bigger than it is, and it's not very sustainable. Now, the second risk here is what happens if the parents die in the middle? What happens to the house? Now, it's right to assume that the house is probably gonna go towards the two daughters. That is something we'll have to find out as well. But what if we had to sell the house in a hurry because the two daughters don't wanna take care of the mortgage? And what if we're facing a very down market right now, like everything is slow? That's something you have to think about as well. Do they have, mom and dad, do they have insurance to cover these things? Another issue here is the poster mentioned it's gonna affect their borrowing power, but only for the next 2 years. Once the daughters are off of the mortgage, they can go buy their house. It will be no problem. It's also not safe to just assume this is going to happen, because what could happen is during those 2 years, you did miss mortgage payment. It's going to show up on the daughter's credit report because you're a co-signer. If that happens and bring your credit score low enough, maybe below the 680, the bank is gonna give you a much harsher calculation on your income ratio, and that will affect your borrowing power. So that's something to keep in mind as well. Now, with all those questions or red flags out of the way, the last thing I would suggest my client to do is look at the bigger picture and preferably have that chat with their parents. See what is their end goal here is. Is it simply holding onto a house, or is it retiring? And you're fixated on that idea of being a homeowner. And so that's why you're doing all these co-signing, but maybe it's better to sell, maybe use the equity to either downsize or rent a place and maybe invest that lump sum on the side so you can actually have cash flow to retire, and you don't have to be so stressed on your business, which is not going well right now. End of the day is you need more info. Don't just blindly co-sign with someone just because they're your family members, because you're opening yourself up to a lot of liability and future headaches possibly. All right, next is we're gonna look at FHSA. So this is a quick one. Basically, the person is asking, they bought a home, but they didn't use the FHSA for whatever reason. I think the bank was being messy with the whole process. And they're just thinking like, is this a missed opportunity? What should they be doing? So first of all, just because you bought a home doesn't mean you no longer have access to FHSA withdrawal. You can still withdraw as long as it's within 30 days of you completing your purchase. Now, if I were you, I would still take the FHSA out as long as I'm still within that 30 days, even if I don't need it for my house. The reason is because unlike RRSP, it really has no caveat, no restrictions. You don't have to pay it back over 15 years. You can take out any amount that you want. If it grows to 200K, if it grows to $1 million, technically you can take out the full $1 million tax-free, as long as you're buying your first principal home at that time. Now, if you don't need that as your deposit, what you could do is actually use it back into an RSP again for another tax write-off. So no matter what, I would take it out if I have the chance. Now, if you miss the chance, it's past 30 days already, I would actually leave it within FHSA for the next 15 years. You have a full 15 years before you have to collapse this and roll it into an RSP. Because being a first-time home buyer doesn't actually mean buying a home for the first time. It means you or your spouse do not live in a home that either of you own for the last 4 years. As long as that's true, you are now a first-time home buyer again. And then which means you can take out FHSA again. So I would keep it in there just in case you qualify for that in the future. But yeah, okay, next question I found was interesting is a professor asking about starting from scratch at 45. He's been living his life, enjoying his life, he's been spending and not thinking too much. Now he's ready to settle down after achieving his PhD, and he is ready to save for the next 20 years. His budget is around $2,000 to $3,000 a month, and he expects himself to work until 65 or 70 even. And he's basically asking what he should be doing. Is he gonna be okay because he feel like he's starting late? I actually have a lot of clients coming to me like this. They're 40, 45, 50, and they're just starting from scratch, and they're very worried about their retirement. Now, the good thing about this situation is that you, just like a lot of my clients, have achieved a very nice income by now, and you have a lot of money to save. So you're actually not in a bad situation. So I've made some assumption and done some very simple calculation to kind of roughly show what you can expect. Now, because I don't know your situation well enough, I'm gonna assume you get 75% of the max CPP, and you're gonna get 100% of the max OAS. And you're gonna be putting aside something like $2,500 a month, and you are first gonna allocate everything towards your FHSA. You're gonna max it for the next 5 years, and then you're gonna put the rest into your TFSA. And once FHSA is maxed, you're gonna switch over to RSP. And once TFSA is maxed, you're gonna put everything towards RSP until you retire. I'm gonna assume you're gonna grow at a modest 6% a year until 70 years old, and that's when we're gonna start all the income, all the benefits. Your CPP with bonus, assuming 75% of max, in today's money, you're gonna expect $1,073 per month. OAS, you're gonna get $990 per month. And for all your investments, at the end, you're gonna be drawing them at 4%, and this will equal to $6,500 per month or $79K per year All these are before taxes. So you should be in a pretty comfortable situation from what I can tell, as long as you have that discipline to keep investing and keep saving and not spend too much. And from planning perspective, there will be two things that can affect your retirement plan. The first one is housing cost. Because you are renting, it can run away from you, the costing. So that's something you have to pay attention to. You might have to or want to consider being a homeowner further down the road. That depends on your lifestyle and your retirement goals, but that might be something you want to think about. Second is your ability to work. So anything that stops you from working, making that income going forward, that's something you need to think about. The two biggest ones I can think about is getting sick and getting disabled. So here I'm talking about risk management, insurances. If I were you, I would really pay attention to the policy from work, understand what you're covered, what you're not, and really consider, especially disability, get a really comprehensive disability going on the side that could potentially convert into an elder long-term care, because elder costs could be another issue affecting your retirement. So there's actually three issues: housing cost, ability to bring income, and also elder care. Other than that, I think if you have that discipline, you're actually not in a bad situation. You should be able to retire quite comfortably. The last scenario here is about retiring and the taxation. So this couple have essentially maxed all their registered account. The husband has significantly more non-registered investment than the wife does, and they're wondering for future non-registered contributions, should they just start an account for the wife and push all those future investments to her, so then she can catch up and they have a more even tax split come retirement. All right, so first of all, congrats on maxing all your registered account. That is a very good achievement. Second of all is you can't simply just push all your contribution towards the wife, because that you will attract something called income attribution from a CRA. Basically, it's CRA's way saying they know this money doesn't belong to the wife, it belongs to you. And so when the wife reports tax on the non-registered account, CRA can come back and say, I think it should be your capital gain and your income and not hers. And they would then push the tax to you, plus all the penalty, plus all the interest, and it can be very messy. From a planning perspective, it's actually not that big of an issue. Because you both have a large RSP and TFSA account, come retirement, you can do a lot of things to even out the tax. For example, you can start withdrawing from a different account. So maybe one of you can do a non-register, which will be cap gain mostly, which will be more tax efficient, while the other person can do an RSP withdrawal first, which will be taxed at all as income. So you can do that to even out your tax, and then later you guys can switch to the other person doing non-reg, the other person doing RSP, or even a mix of RSP and TFSA. So just because someone have a much larger non-reg doesn't mean there is going to be a tax issue come retirement. You can still make it very efficient. So I wouldn't worry too much about the situation. It's not that bad. If you really want to know, you can work with even an accountant. It's not that difficult to calculate how to split the tax evenly. All right, so that's the end of the video. This is what I would likely suggest if this is the only information I have as a planner. Now, of course, as a real client, I would sit you down and I'll spend a lot more time with you and give you actual, advice that fits you. But first glance, this is the answer I can come up with. If you have different answers, let me know in the comment down below. Like I said, this is the first time I'm doing this format. If you like these kind of style, you want to have more of these, let me know in the comment down below as well. And if you haven't already, make sure you like, subscribe to the channel, click the bell button so you get all the notifications in the future. All right, this is Jackie Cole. I hope you like this video. I'll see you next time.